Well, hey everyone, welcome to the Wealth Investment Network podcast. I have a guest with us today, Joel Fine from Lakeline Properties. Welcome, Joel.
Thanks. I appreciate you having me on, Brian.
So, Joel, you and I have interacted just a little bit, but I know you're very popular here in Austin at Ken's meetups, and you're one of the more prominent syndicators in the group now. So I was hoping that you could give some of our audience just a sort of a brief overview of the syndication process and what you guys have going on.
Absolutely, yeah. I attend Ken Harris's meetups on a pretty regular basis. I also run a meetup of my own once a month on Monday evenings. Happy to invite folks in your audience to that as well. That happens at the same place, Casa Chapala, 6:30 p.m. first Monday of each month. But as far as the syndication process itself, I've done, I think, 6 syndications so far on value-add multifamily properties. I've done 1 now on a ground-up development project, and I'm in the middle of my second one on ground-up development. And I've got a bunch more in the pipeline. So I've become fairly familiar with that process, and I'd be happy to walk you and your audience through what I do in that process. Where would you like me to start? Do you want me to start with just the basics of
Well, I'll tell you what. Let's start with an acquisition, because I think it might be a little easier for us to wrap our head around that, and then we can talk through the building process a little bit after that. So, what makes for a good project that you're looking to acquire? I'm sure that it goes through a underwriting and a screening process. Maybe talk us through that, and then the early stages of that, forming your entity, capital acquisition, talking through investors, the business plan, and all the elements to the exit. Maybe just a quick overview.
Absolutely, sure. So pretty much any of this starts with finding the deal, and that in itself is a pretty substantial challenge. Me and the teams that I work with will typically look at several dozen deals before we find one that really works. We put it through a lot of screening criteria, including where the property is, what market it's in, what kind of neighborhood it's in, what condition the property's in, where we think we can add value, whether it's in terms of renovating the units or replacing the management, maybe getting rid of some delinquent tenants and upgrading the tenant base. There's a lot of different kinds of value add, but that's the fundamental phrase, value add. That's what we look for, is an opportunity to improve the property in some way that can then translate into improvement in the business operation, which in turn translates into an improvement in the value of the property so that we can sell it for a profit. So again, it starts with finding that deal, finding the property that meets those criteria. We'll put it through some underwriting. We'll do an analysis of how the property is doing now and how we think we can make it perform in terms of the new rent rates, new expenses, and so forth. If all of that adds up and allows us to bid on the property at a price that we think the seller might entertain, then we'll put in a letter of intent, an LOI. And typically the LOI lays out the broad outlines of the terms under which we'll buy it. So price is the most prominent, of course, how much we'll pay for the property, but there's a lot of other things that go into it. How long we want to do our due diligence, our various inspections of the property, how much earnest money we'll put up that binds us to the deal. Sellers always want to see more earnest money because that suggests a higher level of commitment on the part of the buyer. So these are the sorts of things that will go into a letter of intent. The LOI is not legally binding, but it is an expression of intent between both buyer and seller that, yes, we both do want to go through with this transaction under these terms. Once we reach agreement on the LOI, and sometimes you go back and forth a few times with the seller on the LOI, so don't want to skip ahead too fast on that. And also keep in mind there might be other buyers submitting LOIs, so sometimes it's a competitive process where the buyer and their agent will come back and say, hey, that's an interesting offer, but we've got a bunch of other folks interested in the property. Can you do better? And so you might go back and forth. And so ultimately, if if we're the ones whose offer is selected, if we win the bidding process, the next step is to move from the LOI to the purchase and sale agreement, PSA. That purchase and sale agreement is going to be a legally binding document that reflects the terms of the LOI. So of course, again, it'll have the price, it'll have the timeline, it'll have the amount of earnest money. One of the things about earnest money is when it goes hard, meaning when it becomes non-refundable. So sellers, of course, want lots of non-refundable earnest money, and buyers want earnest money that's refundable. And so there's always a give and take there. But the PSA will reflect what the agreement is between the buyers and the sellers. Once the buyers and sellers reach agreement on the PSA, then the rest of the due diligence begins. The due diligence is going to include physical inspection of the property, typically a walkthrough of all the units. My team, we usually go through it with a contractor and or a property manager that knows how to look at a property and assess what it's going to take to bring it up to shape, so that they can give us a relatively detailed and specific bid on the costs, and we can work that back into our underwriting to make sure we're still in the right ballpark. The due diligence is also going to include an inspection of financial terms, things like rent roll and profit and loss statement, also called the T12, refers to the trailing 12 months of income. Typically, it'll also include a lease audit. So we'll take all of the leases that the tenants have signed and review those. It might include inspection of other documentation like contracts that the property owners have signed, utility bills, you name it. Everything we can think of goes into that due diligence process. Once due diligence is complete, we'll come back with possibly a request to the seller to modify the terms of the sale. For example, if there was a plumbing problem that was discovered during the course of the due diligence, we'll price that, and we may ask the seller for a concession to cover that. While the due diligence is going on, we're also talking to lenders, and we're typically beginning the capital raising process so that we have enough money to purchase the property. We need a combination of debt and equity that'll get us to that purchase price, along with the renovation budget and the closing costs. So that's going on in parallel, where we're working with the lender to line up debt. And then we're typically sharing the deal with our investors. We have a list of several hundred investors that we work with who fund our deals. They come along for the ride. They help to pay for the property. And of course, in exchange for that, they get to enjoy a share of the profits. So then once we complete that, we line up a loan, we get the capital we need, we've completed the due diligence. If everything looks good, at that point we go to closing and we purchase the property. So that's the beginning of the process. Once we purchase the property, if you like, I can go through a little bit of the operation, how we execute the business plan. Where would you like me to take it from here?
No, we could talk about that. I guess how are your deals normally structured with your investors on the buy side? Do you have a preferred return that you offer, some sort of split? How does that work? So let's talk that through, and then we can talk about the actual business plan that you execute to improve value.
Yeah, so that's a great question. Most of my syndications are a combination of a preferred return along with a split between the limited partners and the general partners. Again, the limited partners are passive. They're the ones that help fund the deal. The general partners are me and my team. We run the deal. We do the work. So the preferred return, that refers to a percentage of the limited partner's investment that they can expect to receive as a share of the profits before the rest of the profits are split. So for example, on a 7% preferred return, a limited partner who invests $100,000, if there's a 7% pref, that's going to mean they should expect $7,000 per year before any other profits are split. Now, there's no guarantee that preferred return is going to be paid. It's always possible that the operation won't support it, in which case the 7% will accumulate, and we will essentially owe it to the investor when we sell the asset. hopefully we'll be able to make up for that and cover the preferred return and then some when we sell. That's certainly the business plan to do so. But we like to make it clear to our investors that these aren't risk-free investments, and so it's always possible that they might not get that pref. In fact, they could lose money. We do everything in our power to avoid that outcome, but we like to be upfront and transparent about that these investments do have risk, and that our investors can lose money. That's possible. We don't want to hide that from people. So anyway, it's a combination of preferred return and split. So let's say 7% pref followed by a 70-30 split. And what that would mean if it was a 70-30 split is 70% of the remaining profits after the preferred return is paid go to the limited partners, and 30% would go to the general partners. And the reason you do it that way is to align everyone's interest. The better the deal does, the better both LPs and GPs do. If the deal doesn't do well, then the GPs also don't do well. So we as GPs, as general partners, are highly motivated to make the project go well, to make it a very profitable project. The more profits we can make the project generate for our LPs, the more we get to keep as well. So everybody's interests are aligned.
Right. Yeah, alignment is definitely key, for sure. Okay, so you've got this lined up. You've got the deal cut with investors, and the bank gets their share, obviously, and they usually get paid in preference to the preferred investors as well. So now we have the building acquired, and I'm sure every deal is a little different. Some of them are poor management. Some of them are you need to actually fix the building or improve it some. But let's talk through some normal scenarios for how you add value, either in the building or the management, or what are the common areas that you're looking to improve once you've acquired these buildings?
Yeah, so great question. For us, the ideal value add is going to be a combination of a management change out as well as a set of cosmetic renovations. So when we find properties with management challenges, let's say the management isn't paying attention or hasn't raised rents to market rate, perhaps because they've owned the property a long time and haven't really paid attention to what the market is bearing. Maybe they're not pursuing delinquencies, they're not aggressively evicting tenants that aren't paying. Those are things that we can very easily fix, either by replacing the management or by coaching the management that's on site and having them behave differently. So that's one thing we look for, is an opportunity to improve the way the property is being run. The other thing, like I said, is cosmetic renovations. So if it's just an old and tired property, just like an old and tired house, you can think of it as a fix and flip. So a lot of properties out there, maybe they were built 40, 50, 60 years ago, and they just haven't gotten the love they need. So maybe the flooring and the paint is a little old. Maybe the appliances are not the best. The fixtures maybe aren't as modern as they could be. All of these things are easy to change, easy to fix. They cost money, and so we need to budget for that. But they aren't particularly complex, and so it's fairly straightforward and fairly predictable to say, okay, if we repaint and we replace the flooring and we put in new appliances and we change out the plumbing and lighting fixtures, we know about how much that's going to cost for each unit, and we can do a market study, a competitive analysis of nearby properties to get a pretty accurate idea of what that'll do in terms of our revenue, in terms of the rent. So if we improve a property, if we make it look nicer, we might be able to get, I don't know, just to make up numbers, $100, $200 more per month per unit, and that goes directly from the top line into the bottom line once we've made that investment to improve the property. And so we've got spreadsheets that help us evaluate what that means in terms of returns. So if we spend, let's say, $5,000 or $10,000 per unit, and we can get a $100 or $150 rent bump because we've improved the units in some way, we run that through our spreadsheets, and we have a pretty good idea of what that's going to mean in terms of the ultimate payoff to our investors.
All right, so we've done the normal things. We've fixed it up. We've improved the rents. We've improved the management. Our economic vacancy has gone down. We do this over some period of time, I'm assuming, and I'm assuming that that is modeled out somewhat in your spreadsheets. We're anticipating this to happen over, I'm guessing, a 3-year timeline, something like that. How do you decide when to sell? Like, what's an optimal point to sell, and what are you assuming on your exit cap rates?
Yeah, a lot of good questions in there. So let me try and break that down. So first off, we try to be fairly aggressive in our renovation plan. We try to do our renovations more quickly or as quickly as we can. The faster we can do that, the more quickly we can upgrade the tenant base. Oftentimes, those will go hand in hand. When we improve a property, we'll find that the tenants who used to live there, maybe they're a little more price sensitive, shall we say, and can't really afford a place like the one we're turning it into. And that also often is accompanied by high levels of delinquency. So if those people move out and we get tenants that maybe are have a little bit more in their budget to spend on a place, they're likely to have more pride of ownership, pride to live there, and they'll treat the place better. So these are all good things that go hand in hand. So the faster we can turn the property and make it more desirable, the better. So and one thing about multifamily is you're going to have what you might call organic vacancies. People are always moving out, moving back in, and so we don't have to eject anybody. Typically, we're going to have enough vacancies just from the natural ebb and flow of people that as people move out, we renovate behind them, and then we bring in tenants in the new units at a higher rate. So that's typically going to take between, let's say, 12 to 24 months. 18 months might be a sweet spot, and then maybe another 12 months or so to finish repositioning the asset, turning over the rest of the tenant base, resetting the community's perception of the property. A lot of times people have an impression, a perception of what the property's like, and as we're improving it, we're changing that perception, almost like rebranding it, changing how people think of it. And so that can also take some time. So it's not uncommon for that to take another, say, 12 months to reset people's thoughts about the property. So let's say that whole process takes 3 years is about right. You mentioned that time frame. That's the point at which we would maybe start to think about selling. In some cases, we can sell even more quickly than that. In other cases, it might take longer than 3 years. Really depends on the property and how deep the value add is, what the surrounding neighborhood is like, and how quickly residents, new tenants accept the repositioning. It can also depend on factors that are completely outside of our domain. For example, the overall economy. Right now we're in a rising interest rate environment, which might make buyers more skittish. It's going to increase lending costs. So when a new buyer comes along, they might have challenges in paying the price that we would like to see on a property. So that might motivate us to wait. We might say, hey, interest rates are high right now. The economy's not great. We think we can get a better price if we hold off. So we might keep cash flowing the property at the new higher rents for longer than 3 years. Our business plans typically call for 3 to 5 years. But again, we try to be transparent with our investors and let them know that it could be longer than 5 years. And it's really hard to predict in advance if market conditions are going to be such that we're better off waiting. So we aim for 3 to 5 years. We love it if it can go faster because that way our investors get their money back faster and we can all turn it around and put it in the next investment more quickly. But 3 to 5 years is typical, and sometimes it can go longer.
Yeah, so let's talk about that a little bit. You have to make a certain set of assumptions when going in about what your going out cap rate is going to be. And nobody has a crystal ball. I think we've talked about this a little bit before. What assumptions are you making there? And then can you talk us through a little bit about how that impacts the investor's returns and then the duration of the project? Because the bump and at the exit for the investors, some of the return might be derived from that too. So can you talk us through, do investors make more or less depending on the duration of the project? And then also kind of like how you think about the going out cap rate when you purchase a project and you underwrite it.
Sure. So just in case your audience doesn't know what a cap rate is, that's kind of an inside baseball term. Cap rate is a measure of how much investors value a given dollar of income. You can think of it as the amount of money that, or the return you would get if you bought the property with no debt. So if I bought $1 million property, paid $1 million cash for it, and it made me $40,000 per year in income, well, 40 divided by $1 million is 4%. So that'd be a 4% cap rate. So what that means is that the higher the cap rate, the lower the sales price of an asset. So when we're buying an asset, obviously we want a nice high cap rate, because that means we're getting a lot of income for relatively little money. And when we sell the asset, we want a low cap rate, which means we're getting a lot of a high price for relatively little income. So again, on the buy side, you want a high cap rate. On the sell side, you want a low cap rate. But when we underwrite, we don't assume that we're going to get a low cap rate when we sell. In fact, we assume typically a high cap rate. That's a nice conservative assumption, which allows us some wiggle room in case things don't go well, in case the economy turns in a bad way. And we can always delight and surprise our investors if we can sell for a lower cap rate than we've assumed in our underwriting. So we typically use a relatively high cap rate. And what we'll do is we'll look at the area and the asset class and see what the typical cap rates are in that area and asset class at the time we're buying. And then let's say we've got a 3 to 5 year time horizon on the business plan. We usually increase the cap rate in our analysis by about 0.1% per year of hold. So what that means is if we're buying in a cap rate environment that's 4% and we're doing a 3 to 5 year hold, we might assume in our underwriting a 4.5% cap rate. Again, we're hoping that's too conservative. We're hoping we can sell for a lower cap rate than that when the time comes. But by making the assumption that it's a higher cap rate of 4.5, we think we're building in some conservativeness so that we've got some room in case things don't go to plan.
And what portion of, do you have any sense for what portion of the overall return that an investor gets is derived by these exit cap rate, either assumptions or actually the realized exit cap rate? Is it on the order of 50%, or do you have any sense for that?
Well, it's hard to say. I mean, returns are pretty sensitive to cap rates, but the way I would look at it is more in terms of the split between cash flow and appreciation. So in our deals, we typically aim for a cash flow of 7 to 8% per year and an overall return, an internal rate of return, also referred to as IRR, of 14 to 17%. That's the range we aim for. So roughly speaking, that means we're getting about half the return from cash flow and half from appreciation. And that's the sweet spot for us. It doesn't always work out exactly that way. There are some situations where, let's say there's what you might call a deeper value add, meaning you have to spend more money on the property, perhaps because there's more deferred maintenance or there's real problems, let's say a parking lot or a roof that needs to be replaced. And so you've got to spend a lot of money to really fix the property. But then once you've spent that money, you can increase rents and reduce expenses substantially. And in situations like that, we might see a lower cash flow, less cash on cash return, but at the end, we'll get a bigger bump from the appreciation. So the most important number is that IRR, where we aim for in the range of 14 to 17, sometimes even a little bit higher % per year. And sometimes that's going to shake out to be a little bit less than half of that in cash flow. But as long as we can make up for it towards the end, then that can make for a good investment. We just, again, have to communicate with our investors, be transparent, and let them know what to expect. So that if the cash flow is a little bit lower, especially on the beginning stages when we're spending all our money on the CapEx and on the renovations, our investors aren't negatively surprised.
And the investors should not be surprised about the risk to go with it too. So, if you're going into a deeper value add project, a lot of those cash flows are going to get pushed closer to the end, and they just need to go in eyes wide open, knowing that there might be more perceived risk and being able to execute that business plan, and also that the exit cap rate assumptions might matter more for that type of project than they would for more of a cash flowing project.
Yeah, and in fact, that brings up another point we could talk about. I don't know if you want to take it in this direction at this point, but we also do ground up development projects, and ground up development you could think of as sort of an extreme case of the deep value add, in the sense that there's no cash flow whatsoever, because we're starting from bare dirt. So there's no tenants, there's no rent coming in, there's no income, and so there definitely will not be any cash flow payments to our investors as we go. But with a development project at the end, we've got hopefully a beautiful brand new property. Let's say a nice value add, or sorry, not value add, but a nice Class A multifamily property or some other asset type, and we'll lease it up and get it tenanted. And at that point, we've got a property that we can then sell for hopefully much more than we put in terms of the price of the land and the cost of the construction, which means a really nice appreciation bump, but again, no cash flow along the way.
Yeah, so let's talk about that. So I have on here, I wanted to talk about the Austin market. So it seems like this is a really good play in the Austin market right now, just because there's, 150 people a day still moving here. I'm assuming most of the stuff you look at in the Austin area from an acquisition standpoint probably makes very little sense. You're probably bidding with other REITs and other places that just have a lower cost of capital than you all do. I mean, what is the motivating factor for ground up development and pursuing that and spending time and energy on that versus an acquisition target?
Yeah, so you're right. A lot of deals in Austin are very difficult to make pencil. There's a lot of money chasing those deals, and so cap rates are extremely low. We see deals with cap rates as low as 3.5% now. And for those in the business, for those that understand, what cap rates typically are, that's extremely low. It's really hard to make a deal look like it's going to underwrite well and return a good profit to our investors when it's selling at a 3% cap rate. And so, we're finding that the margins are often quite a bit better on the development side. There's a fair amount of land around the immediate city of Austin that's still relatively inexpensive on a per acre basis. And when we add that to the cost of new construction and look at the kind of rents we think we can get, the numbers are fairly compelling. That we can get a much better margin on a lot of these properties than we can on the value adds that are more, let's say 20, 30, 40-year-old properties in Austin. So, that's our sweet spot has been properties that are in the path of progress, maybe a little bit outside of the city of Austin. One of the interesting characteristics of Austin itself that I would contrast with other cities is that there's a very sharp drop-off in the price of land as you get away from the city center. And that's more true of Austin than it is of other places I've looked at. For example, Phoenix is a market that Austin is frequently compared to. And I know folks in the Phoenix market. I've looked at land there. And in Phoenix, you have to go a long way away from the city center before the price of land really tails off at all. And that's just not true of Austin. You can go maybe 20, 25 minutes out away from downtown, and the cost of land drops by a factor of 3 to 10. It's really pretty remarkable. And so we've got some projects underway that are a little bit out of town, but still well within commute distance that we're fairly confident are going to generate a lot of interest and a lot of demand. As you point out, there's still lots and lots of people moving into Austin. People from California, Illinois, New York, other states around Texas are coming into Texas at a very high clip. And that's creating a demand that on the supply side, the city and the metro area are really struggling to keep up with. So with that supply demand imbalance, everybody who's in the market for a property knows that prices continue to go up. Properties don't stay on the market for very long on the residential side. Rents are going up very quickly. And so all of that for us is a nice tailwind that helps protect us against the downside on development. So, I want to be clear again that we're transparent with our investors that all these investments have risk. Development projects can have more risk than value add multifamily. In particular, since we're a little bit outside the city center, if we're wrong about the path of progress or the rate of growth of Austin, that wrongness can translate into a much bigger change in the expected outcome of the investment. So with a value add multifamily, it's relatively predictable how much you can get in rent for a given set of improvements to the property. With development, you're starting with bare dirt. You may not even have any neighbors around you. So it's much harder to predict with accuracy what you'll get out of the property. When we build an apartment building, we'll make predictions about how much rent we can get, but there's a wide range of outcomes that could actually result. So we hope we underwrite well. We hope we are accurate or even conservative. We hope we'll get more rent than we predict, but we try to make it clear to our investors that that's not guaranteed. And if we end up with less rent than we predict, then our returns are not going to be as good as we project. So again, we try to be transparent with our investors and let them know that what the risks are in the investments.
What about your execution risk on the development? Assuming that some of these areas, the infrastructure isn't as developed as it is near the city of Austin, which may or may not be a good thing, depending on how your opinion of the city of Austin's infrastructure, which I have some pretty strong opinions about that. But is that a consideration in your underwriting for these types of projects, and how are you thinking about that?
Absolutely, yeah. So that's always a risk, entitlement risk and permitting risk, and just making sure you can get the project through the process. One of the nice things about the projects we've done so far is we haven't actually been inside of Austin city limits yet. Some of our projects are in what's called the ETJ, extraterritorial jurisdiction. That's a Texas concept. It's a ring around every city where some of the city's rules apply, but one of the things that does not apply is zoning restrictions, which means the city can't tell us what we are allowed to build. We could build a high rise, we could put in a junkyard, we could put in an RV park or a mobile home park, whatever we want when we're in the ETJ. Obviously, it has to be a safe structure. It has to meet environmental restrictions. We can't, build on a watershed. We have to watch out for floodplains. We've got to make sure that we've got utilities, electric, water, sewer. So a lot of things are still very relevant, a lot of the restraints and risks, but zoning isn't one of them. When we're outside of the city of Austin, we know that we'll be allowed to build what we want to build. So that's one of the ways we mitigate that risk is by being outside the city of Austin. Austin itself is notoriously difficult to deal with, so that eliminates one set of those risks. But there certainly are, other risks associated with the execution. Like we mentioned, the utilities. In some of the places we're building, maybe there's water, but the water capacity is not sufficient for adding, let's say, 250 apartment units or 200 townhomes. Maybe the power grid isn't ready for that, or sewer isn't in the property yet. So we work with the utilities to make sure that either they are there in sufficient capacity, or they have plans to be there. And sometimes those plans include a cost that we've got to factor into our underwriting. So that's among the risks that we deal with. And one of the ways that we earn our keep as developers is figuring out those things and identifying ways to resolve, to mitigate those challenges, to make sure that we've got the infrastructure, that the roads can support the additional incoming population, utilities are there, all of that. That's all part of the task that developers have to go through to make sure that whatever they build can function, can be occupied, and can work in its intended way. So yeah, you've touched on one of the key challenges and risks in development, and that's certainly something we spend a lot of time on, especially early on as we're doing due diligence. Let's say we identify a piece of land that could be interesting for an apartment complex. That's among the first things we'll look at is those things, the infrastructure, the utilities, and so forth.
All right. Well, I wanted to shift gears here a little bit, and a lot of our folks on the call, I'm sure this is very informative for them, but one of the things they're probably thinking about as they decide who to partner with on projects is the character of the sponsor or the sponsoring team. Can you talk our audience through a little bit of what you would look for as a limited partner if you were going to invest some of your money in other people's deals, and just how you generally think about that?
Sure, absolutely. And yeah, in fact, I do a lot of passive investing myself. I'm a limited partner in quite a few deals, so that question is very relevant to me in both directions. I definitely ask those questions of any new sponsor that I'm considering, but I also ask those questions of myself. Am I living up to the standards that I would apply to a sponsor that I'm thinking about sending my money to? So among the things I look at are, first off, I've got to have a great deal of trust for that sponsor. It's a passive investment. I have no control over it. In effect, I'm just handing over some substantial amount of money, that's $50,000, $100,000, sometimes more, to that sponsor, and trusting them to treat that money well, to use that money in a way that's appropriate, to make good judgments, good decisions. And so that's all about trust. So that's the first step, is I want to make sure I trust that sponsor. And there's different ways to develop that trust. One way is just to get to know the sponsor personally. And that's one of the reasons that I try to get to know as many investors as I can in the area. I try to develop personal relationships with lots of investors so that they can get a sense of who I am, what my character is. So that's why I attend meetups. I run my own meetup. I have lots of Zoom calls or coffees with potential investors, so that people can get to know each other. People can get to know me and understand how I think, how I operate, and draw their own conclusions about my trustworthiness. So that's one thing, is trust. Another thing that's maybe a related concept is transparency. So for me, it's very important that any sponsor that I get involved with be transparent, not just as they're soliciting my money, but also throughout the life of the investment. What's happening with the project? How is it going? How does it compare with the business plan? What are the challenges? What are the risks? When let's say a risk does come to fruition, a problem happens that we thought might happen, but we're hoping that wouldn't. What are they doing about it? And what are they sharing with their investors, so the investors can understand what's happening and be confident that the risk is being dealt with in an appropriate way. So transparency about the investment, about the risks, and about the ongoing operation is another important thing that I look at when I consider a new sponsor, and that I encourage my passive investors to look at. Other things passive investors can think about is education is an important component of any investment decision. Some passive investors like to be more educated than others. I encourage my investors to learn as much as they want to, as much as they're comfortable with, not only about my particular deal, but about my background, about my track record, and then even beyond that, about syndications and real estate investments in general. What are the parameters? What are the things to look for? What are the risks in most deals, and how do those apply here? Different investors are going to have a different appetite for how much of that they want to consume, how knowledgeable they want to be. Some investors they just want to say, hey, I found a sponsor I can trust. I'm going to invest in their deals and not really going to think about it much beyond that. And that's fine. But for other investors, I help them identify ways to get themselves more educated as and when their time commitments allow it. So anyway, that's kind of a long answer to your question. In summary, I'd say
No, that's
trust
great.
and transparency are the two most important things. Beyond that, maybe track record. Those are the things I look for.
And how do you think about that in terms of investment size too? So I always like to think of the syndication game as a little bit like a dating game. You don't get married on the first date. People could invest a lot of money in one deal, or they can invest the same amount of money, which is probably still a substantial amount of money, but they could break it into 4 or 5 different deals. I mean, how do you think about that, and how do you think about investment size as part of their risk capital profile with a new relationship? How should people think about that?
Yeah, that's a great question. I mean, it's going to be different for every investor. My syndications typically have a minimum investment of $50,000, which for the vast majority of people is a very significant amount of money. So I know that when I'm inviting people into a syndication, when I'm offering them the opportunity to invest, I'm asking for a very substantial investment. Some people invest more, and that's great, if they've got the means to do that. But I try to make it clear that, I respect that $50,000 is a lot of money, and that on the flip side, my investors should recognize that it's an illiquid investment, that it's going to be in the deal for 3 to 5 years, could be longer than that, and they're not going to be in control of when the deal wraps up. It's going to be up to me and my fellow GPs, my general partners, to decide when it makes sense to exit the deal, to sell the asset. I'll certainly listen to my limited partners and accept their input and their advice, but I need to make sure they understand that they're not in control of that decision. So it's got to be money that they can afford to leave in an investment for a relatively long period of time, for 5 years or potentially more. So if it's money that they think they're going to need in 2 years to buy a house or put a child through college, it's not an appropriate investment. But if it's money that they're thinking of saving for, let's say, a down payment on a house in 10 years or retirement, then it could be suitable. As far as the amount, again, $50,000 is the minimum. I often get investors who invest more than that, but whatever that amount is, it's really going to be up to the individual investor what they're comfortable with and how much they want to put in any one deal. One nice thing about syndications is it can allow for diversification in a way that other real estate classes can't. If you buy, let's say, a duplex or a nice house to rent out as a real estate investment, let's say the house is going to be, I don't know, $500,000, $700,000, then you're probably going to need to put in at least 25% down. So you're looking at $150,000 or more for that one investment. On the other hand, with syndications, with a $50,000 minimum, you could take that $150,000 and put it into 3 different assets, and that could be 3 asset classes. It could be three different markets, say one in Austin, one in Florida, one in Tennessee. So you can really diversify in a way that you can't with other kinds of real estate. So that's one nice thing about syndications.
So Joel, my understanding is you have a new project out near, relatively close to the Tesla facility out in East Austin. Can you tell us a little bit about that and what you guys have going on?
Absolutely, I'd love to. Yeah. So what we're planning out there is we've got 15 acres, of which we've already acquired 10 acres, and we're about to buy the other 5. And on that 15 acres, we're planning to build a mixed-use development. It's going to be a combination of apartment buildings and retail plaza. The apartment buildings are going to be, there's 5 buildings. We're going to put up 265 units in 5-story buildings. And then we're going to have a retail plaza that we're still in the early stages of planning the site, but it's looking like about 40 to 45,000 square feet of retail space. We're likely to have that anchored by a restaurant. The property is about 5 minutes from the Tesla plant, so it's really well situated. Right now, that neighborhood is somewhat undeveloped. There's some houses out there, but there's also a lot of land that really just hasn't been built. And so being so close to the Tesla plant, we're going to be among the first multifamily options available to Tesla employees. And with that Tesla plant's proximity, Elon Musk has previously announced something like 20,000 employees on site when he's done building there, along with he's estimating 100,000 indirect jobs in the immediate neighborhood. With those kinds of numbers, that's going to have a profound impact on the neighborhood. It's going to really change the neighborhood. And so, we're putting up these apartments and the retail plaza, I think, at a fantastic time, because demand in the area is just exploding. The nearest multifamily is about 5 miles away, and we went and visited it. It's a nice property. It's brand new, and they said that they already have, this was back in November, before the Tesla plant had even opened, and one of their, I think, 6 buildings was filled with Tesla employees. So we know that there's going to be substantial demand. And so we're really excited about this project. We're just now in the process of raising capital for it, getting money from investors to help pay for the purchase of the land, as well as what we call the soft costs. That's the civil engineering, the architecture work, the surveys, working with the utilities to do their studies, maybe a traffic impact analysis, a long list of things we need to do before we're shovel ready, meaning we're ready to actually move dirt and put up structures. So all of that work to get us to shovel ready, it costs money to get this work done, to pay people to do it. And so we're raising money for that now in a 506c offering. Because it's a 506c, that means we're allowed to accept investors that we don't already have a personal relationship with. We can advertise for it, so I can talk about it on your podcast. We can only accept accredited investors. So accredited investors, in case your audience doesn't know, is people with a net worth of over $1 million or a gross income of $200,000 or more for the past couple of years, or $300,000 when combined with their spouse. The SEC has those rules in place as a way to protect unsophisticated investors, to make sure that the people who are investing have the wherewithal and the means to evaluate an investment like this. So anyway, we're early in the capital raising process. By the time this airs, there's a good chance we'll be in the middle of it. But we expect to be raising capital for a while, so good chance that the raise will be open. And so folks who have an interest, they're welcome to go to my website or send me an email, lakelineproperties.com, joel@lakelineproperties.com, and inquire about it. Happy to share information. But it's a really exciting project. We're just at the early stages, at the beginning, and so we're excited to offer investors a chance to get in on the ground floor of this project. And we think it's going to be, just like I said, just tremendous demand from all the people and the jobs moving into the region.
Right. The Elon Musk train, too, out there at Tesla. And I don't know if anybody from the audience has been by the building, but my wife and I drove by it on our way back from Lockhart. And it was just amazing to me how big the building was. It just kept going and going and going. I think it's one of the largest buildings in the country now, or maybe even in the world. So, exciting project. Well, thanks, Joel. Really appreciate your insight and analysis. And I know you shared your website. And look forward to chatting with you again and learning more about your project, possibly.
Well, thanks so much, Brian. Appreciate you having me on.